Okay, you all should have heard that announcement, and welcome again. This webinar is brought to you by the Small Business Succession Planning Program at Kent State University. We're part of the OEOC. It's a nonprofit training and outreach organization located at Kent in Kent, Ohio. We focus on job retention and business growth by helping small business owners learn more about the importance of early succession planning. Today we have Jim Awesome of Kavich, Famillo, and Durkin here in Cleveland. The title is Where the Business Plan, Strategic Plan, and Succession Plan Meet. So with that, Jim, take it away.
Thank you, Jay. Good morning, everyone. Good morning to some of my friends. I see Bill Manby, I see Tim Sisler, a couple other names that I recognize have signed up. I don't see them signed in yet, but I'm glad you're with us. I've been doing this for some 35 years. And I take the approach to what I call succession planning, which includes family succession planning or succession planning related to closely held businesses, as a practical approach in the sense that I think it needs to be done in such a way as it is a process as opposed to an event. A lot of people think that is a legal event where you sit down and you draft documents. And that's the last thing that you actually do when you're talking about how you're going to dispose of your business, whether you're going to dispose of your business by selling it, whether you're going to dispose of your business by passing it along, or whether you're going to die with your business. And if I'm on slide 2 right now, and this is kind of one of these tongue-in-cheek things. If, in fact, you have a closely held business, and most of you either have one or you are advisors to people who have one, I suggest to you they essentially have, or you have, 3 options. If you die with your business, it is your problem in the sense that you haven't gotten or realized or enjoyed, if you will, the value of your business because you died owning it. You haven't converted it to cash, it hasn't been liquidated, etc. And the opportunity to enjoy that is lost to you. If you pass it along, you are still part of the problem or the solution or the enjoyment, depending on how you do it. Because clearly when I talk about it being our problem, I'm talking about your family, your employees, your suppliers, your customers. You're all involved with it being passed along and plan, your exit plan or your business plan. I think they're all, in some degree, woven together. Is a function of good planning and having a process to arrive at that plan. And hopefully that's what we're going to explore for the next 50 minutes or so. And certainly one of the things that is an option when you have a closely held business is to sell it. And when you sell it, it becomes then the buyer's problem. And the buyer's problem may or may not be your problem. Generally it's not. But the reality is if it is a closely held business, you are probably going to have to finance as a owner of that business some portion of the purchase price for the purchaser, whether or not the purchaser be an unrelated third party, whether or not the purchaser be the existing management team, whether or not the purchaser be your family members, or some combination of the latter two, management as well as family members. So therefore, the success of the business and the success of the business plan as part of the strategic and exit plan is essential to make sure that you realize what you want from the enterprise. Obviously, if you're lucky enough to sell it to a public company or a private equity firm, you might be able to cash out in cash, but that doesn't happen very often. I do this for a living. You'd be surprised how few times people actually sell, receive all their proceeds at closing, and never to be involved again. Plus, obviously, you've got reps and warranties that do impact what happens with that business going forward. I'm on slide 3 right now, and I think, at least in my experience, when you own a business or are a owner of a business, it virtually takes over your entire life in the sense that it is your lifestyle from both a dollars and cents standpoint, plus it is your lifestyle in terms of your personal satisfaction and kind of defines who you are. If you want a challenge someday, when you attend a meeting where they ask you to go around and introduce yourself, most people say who they are, what they do for a living, whether or not they're married, and how many children they may have, and perhaps where they went to school. I've attended those meetings, particularly strategic planning meetings, where I've asked people to go ahead and tell the other participants who they are without telling us what they do for a living, whether or not they're married, and how many kids they have. It's a much more difficult assignment. So really, the reality is we in the United States define ourselves by our success, our business acumen, and what we do for a living. And that pervades your family lifestyle as well, because obviously your closely held business enterprise impacts that tremendously. It defines your ability to retire and your security. And if you're like me, your profession kind of defines your satisfaction with your life. Certainly your family, your spouse, your kids, your spiritual life defines that as well. But I think in reality, being involved with your business is essential to having a successful and favorable lifestyle. Or there are some of you, and I won't ask you which ones, and some of you can volunteer if you'd like. Maybe you have your own business simply because you can't work for anyone else, and that's not an unusual situation I have found. I think to a large degree, I come from that category of finding it difficult to work for other people. Jay, I want to get to slide 4 up there. It's not opening for me. Perhaps it can open for you. There it goes. All right, slide 4. This begins what I'll call the nuts and bolts of how we actually do this and where the business plan and strategic plan really come together. Usually, whether you're selling the business or passing the business on to unrelated third parties or to members of your family, you as the seller or the transferor have to take a look at what you need from the enterprise. If you have been successful enough to accumulate a lot of wealth inside your qualified plans or in your portfolio of securities or in real estate investments or other things, you may not require anything from this business from a practical standpoint. Majority of my clients are not so lucky. They require a significant cash flow from their enterprise into their retirement years, etc. And so therefore we must devise a way to make sure that their financial requirements are taken care of. So the first W is, what do you as a senior generation or the owners require, or what do the senior owners that you want to buy out, whether they be your family members or your partners, require from the business to make it a viable transition? And one of the things that I always caution the senior generation about is being realistic as to how much their enterprise actually pays of their personal lifestyle. For example, most people own their own business, haven't bought a car, bought gas for that car, paid insurance for that car, gone out to dinner without in some fashion figuring it's related to their business or used the business credit card for years. And it's not uncommon to find out that there is anywhere from $1,000 to $5,000 a month of what might otherwise be personal lifestyle expenditures that are coming out of the company, and once the company is sold or your interest terminates or your interest reduced for tax purposes, can no longer be justified as being paid from the company. So when you're figuring out what you need and how to jump into this plan, both from a business plan and strategic plan standpoint, you've got to get your arms around what you need or what the people that are selling it to you will require. The second W, or second what, in my analysis is, what can the business afford? The business itself must remain a viable entity in order to implement any form of succession plan, particularly a succession plan that's going to be effectively a leverage buyout whereby the buyers are going to use the cash flow from the enterprise to take care of the first W, the first what, for the senior generation. They're going to pay them from the company's cash flow. In addition, the company itself must remain a viable entity, so it has requirements in terms of capital expenditures, in terms of research and development, in terms of expansion of markets, etc. And the second generation, or the buyers, obviously want to pay themselves well. So by definition, the business generally has to grow for the business to be able to afford its continued success and the buyout of the senior generation. So effectively, the second what can the business afford, that's your business plan. That's where you are putting together a business plan that's going to provide for the success of this business, as well as the funding of the buyout or the acquisition, the debt service. How much free cash flow can the business generate after it takes care of all of its debt service, all of its operating needs, and then be able to pay either the buyer or pay the bank that has afforded the acquisition financing. The third what is what's the business worth, and a sub paragraph of what is fair. And what I mean by that is, if you put together a succession plan after doing the first two steps, the senior generation requires, let's say, $3 million. And they require that $3 million in approximately $200,000 a year. And they figure they have a life expectancy of 15 years. So they want $200,000 a year over 15 years. Now, $3 million paid over 15 years is not $3 million in terms of present value, substantially less than that. So for tax purposes, that business is being sold perhaps for $1.8 million. If, however, that business is in fact worth $5 million and the transfer is from dad to children or related parties, the Internal Revenue Service is going to look at that and say, those children are the natural objects of the seller transferor's bounty, and therefore the transferor who is transferring a $5 million business for $1.8 million is making a $3.2 million gift, on which the transferor must pay gift tax, and gift tax is 45% of that $3.2 million. That's an ugly result. In fact, the transferor is going to pay more in gift taxes potentially than they're going to realize from the sale of their business. So we must know what the business is worth, usually done by the appraisal by qualified an accounting firm or valuation firm or otherwise, and it's almost a starting point in terms of what the business is worth to be able to pull together a successful business strategic plan. What is fair deals primarily with family enterprises. For example, if there is a member of the family who joined the business at age 25 and now they're age 50 and they've put in 25 years worth of blood, sweat, and tears, and the business at the time they came in 25 years ago was worth $2 million and now it's worth 10, did they contribute to that increase in value? Certainly from their perspective, they're going to say they did. And should they have to pay full value for the business since they're going to take it over, since they created some of the value? On the flip side, there are members of the family who may not be involved in the enterprise, yet the senior generation wants to make sure that they inherit some of the family wealth, and therefore they should share in the enterprise's value. And if the enterprise is really worth $5 million, and it can be transferred to the next generation for $1.8 million, and that's the only proceeds that will flow to the senior generation, are the other members of the family who are not participants in the family enterprise receiving cash, salaries, bonuses, and benefits really being penalized because they have not participated in the business? So you have two factors when you're talking about being fair. Does the generation taking over the business get some form of credit in putting together the plan that gives them credit for the sweat equity, part of the value that they have created, as well as whether or not the generation or the members of the family who are in fact not involved in the business are going to be treated fairly in the overall inheritance. If you have questions, I would encourage you all to go ahead and indicate so in the chat box, so we can in fact address those questions as they come up. That's a much more effective way as opposed to waiting to the end to in fact see whether or not we've answered some of your questions. So I'd rather address them when they're fresh in your mind. So if you can do that, please do. I am moving on to slide 5, and there's a slight delay I'm noticing, but hopefully we'll be on slide 5 in just a moment. Slide 5 deals with the nuts and bolts of how we actually assemble an actual plan. And I call it the 4 Ds. And I submit to you that the 4 Ds apply whether or not you are involved in a family enterprise, whether or not you are involved in a closely held enterprise, and they also apply to your family, etc. You must address as part of this plan whether it be passing ownership on or passing management. Because keep in mind, succession planning involves not only ownership succession, but the strategic plan aspects involve management succession. Who is going to run this business? And therefore, you must address what happens when an owner, manager, key person dies. Is that person, is that owner required to sell their interest, or can they continue to own it? Can they pass it on to their family? May it be part of a trust on an ongoing basis, or should they be cashed out? And obviously, if they're going to be cashed out, you need to determine how they'll be cashed out, installments, use of life insurance, or otherwise. And as we talked about in the 3 whats, what is the value of the enterprise that will be used to cash them out? And frankly, death, because of the availability generally, assuming the person is insured, of life insurance, is one of the easiest of the 4 Ds to address, because basically what you're focusing on is whether the owner, manager, key person is going to be cashed out with perhaps life insurance proceeds, and if the proceeds are not sufficient to cover their total value, then perhaps installment payments. Or are they going to pass it on to the family? If they're going to pass it on to the family, again, life insurance becomes a very important ingredient, because life insurance then is available to pay the estate taxes that may be attributable to the ownership interest. And by the way, I do think that Congress will eventually, in 2010, pass estate tax legislation that will freeze the estate tax exemption equivalent at $3.5 million. Although I do think that people who have died so far in 2010, and I have some of those people, will in fact have a no tax year. But that remains to be seen whether or not Congress really can make it retroactive. The other 3 Ds are disability. For example, if I'm going to pick on the architects because I know there's some listening to me, it's just like lawyers or CPAs, and I think there was going to be a CPA involved in this discussion as well. If you're involved in a closely held organization and you become permanently disabled, in other words, unable to continue to practice your profession, what does that trigger? Does that trigger a liquidation, a buyout of your interest? Does it trigger a reduction of your compensation? Does it trigger long-term payout? Does it trigger a reduction of your long-term payout by the amount of any disability payments you receive over time? Does it require that the interest be sold, or does it allow you to pass it on? It's one of those things that's kind of interesting when you address it that way. Now, if in fact the ownership interest in the closely held enterprise is ownership interest in a management company or a real estate holding company that owns real estate assets that can be managed by an independent third party on your behalf, then perhaps the owner's disability is not a critical event that addresses ownership interest. But certainly disability has to be addressed, and the insurance people and the actuaries will tell you that we are more likely, 6 times more likely, to become permanently disabled, unable to render valuable services to our closely held enterprises than we are to die before reaching age 65. So if you have multiple partners in an organization, it's likely, statistically, that one of you will be unable to complete your obligation to the organization on a permanent basis. Departure is the 3rd D. And in my vernacular, departure means what happens when somebody wants out of the business. They are, in fact, burned out. They want to move on. They want to do something different. Or you want them out for lots of reasons. But the point is, they are going to leave the enterprise. Does that trigger their buyout? May they keep their interest? Do you want an owner who is no longer involved in the enterprise to continue to have an interest in the enterprise? Usually the answer to that is no. But then if you have to buy them out while the enterprise is still starting or is perhaps going through a difficult time, how do you determine what their buyout will be? And will the buyout, if someone leaves during their lifetime, be an extended buyout as opposed to a buyout that would perhaps occur on their death because you have life insurance proceeds to fund it? And people do leave enterprises. To have 4 people stay in the same business and get along with each other for 25 years and all retire from that enterprise and sell to unrelated third parties is the exception, not the rule. So departure does take place. The 4th D, discord. I tell clients, if you have no discord, it may mean that one of you is not thinking. The concept being that you might have discord, but we try to find a way to manage that discord so we reach a consensus, a commonality that is in the interest of the business. And one of the ways to perhaps resolve discord is to deal with ultimate exit strategy. If, in fact, you have a business partner, whether it be a family member or a non-related family member, who you think is detrimental to the enterprise's future, or for whatever reason, maybe just making you crazy, then the ultimate discord exit strategy is a put and a call. A put is where the seller tenders their shares and says, I want to be bought out, I want to leave the enterprise. A call is where the buyer comes to the disgruntled or perhaps interfering partner and says, I want to buy you out, I think you're detrimental to the enterprise. The problem always becomes, if you're a buyer, you're relieving the seller of their various obligations. The business is struggling, and it's not worth very much. If you're a seller, the business is a home run. It's the best enterprise that you ever had, and you owe me a premium because you're buying me out early. And obviously that's the problem, because people do not agree on the actual purchase price. If they're a buyer, they want it low. If they're a seller, they want it high. So the twist on the put and call system is slide number 7, push-pull mechanisms. And basically that's a put and a call. You have an agreement that says if there is a buyout due to one of the departures or discord, that buyout will be over, let's say, 5 years. And that buyout will include an interest rate that is a fair market rate of interest, maybe tied to LIBOR or Key Bank. And that payment will require that payments be made over 5 years and personally guaranteed by the buyer. And the seller will agree not to compete with the buyer, etc. So you have all of the terms in place except whether someone is buying or selling. Then when you get to a point where one of you wants to buy the other person out or one of you wants to sell and get out, then they approach the other person and says, all right, I will pay you over the 5 years, bearing interest as we discussed, all the terms that we discussed, and I will pay you $3 million for your interest in the business. Then the person who was approached, the person who is the offeree from a legal standpoint, has 2 weeks, could be 10 days, could be 30 days, but you want to make it a reasonably short period of time, to decide whether or not they want to accept that offer as a seller, or whether or not they are willing to then buy out the offeror, and they become the buyer, and they will pay the offer or the $3 million. Now the reason this is an effective mechanism for putting together a business plan, strategic plan, and ultimately an exit plan, if in fact you need an exit plan because it's going to be detrimental to the business if you stay together. It addresses the monumental issue. What is the value of an interest in the enterprise? If you offer to buy out the other member, your offer must be reasonable. It must be doable. You must have a business plan that allows you to figure that you can make that $3 million payment over the next 5 years, because you don't know whether or not you're going to be receiving $3 million over 5 years as a seller or paying $3 million over 5 years as a buyer. So it acts as the natural deterrent to make sure that people are not trying to manipulate the system. It can be very effective, and is certainly a good mechanism for putting together a workable, realistic succession plan to address what could be significant acrimony that could in fact destroy the business without a viable exit strategy. Now, I'm at slide 8. We have been talking about various strategies and how to realistically implement a succession plan coupled with a strategic plan. And one of the things that's critical to putting together such a plan, both for tax purposes, for drafting of documents, for buying the amount of life insurance that might be appropriate, for perhaps addressing whether or not a disability or long-term care insurance program should be implemented. There's lots of reasons you need to do this, is we must arrive at the value of the business. And everyone I assume that is listening to this discussion is in a closely held enterprise or advises closely held enterprises, so you know that we can't go to the Wall Street Journal and we can't look up the value of the enterprise. So therefore, for tax purposes, which is Section 2703 of the Internal Revenue Code, and for practical business purposes, we must arrive at some mechanism for determining what the value of the enterprise is. The mechanisms that are used are a formula. For example, formula might be some percentage of gross revenue or some percentage of net profit before income taxes, some percentage that might be earnings before income taxes, before interest, taxes, depreciation, and amortization, so-called EBITDA methodology. There's lots of formulas, and your accountant can help you arrive at a formula. The only thing I caution you about in using a formula is to test the formula today and test it again every couple of years, because a formula determined in 2010 may be very applicable to the 2010 facts that you have for your enterprise, but may not be even close to the facts and the circumstances and the interest rates and the economic conditions that may affect your enterprise in 2014. For example, formulas that might have been entered into by clients in 2005 probably had no semblance of reality to the economic conditions of 2009. So you must constantly test whether or not your formula is an accurate representation of the value of the business, which is why formula is probably my least favorite mechanism. Appraisal is my favorite mechanism, because an appraisal is an independent third party who's going to arrive at a value. And one of the things I do with appraisals quite often is I use a three-pronged appraisal method. And the three-pronged appraisal method simply means this. If someone dies, if someone becomes permanently disabled, if somebody wants to leave the organization, if there is discord in the organization, then that person pays for an appraisal. The buyer can accept the appraisal and buy the person out at the appraised value over the 5 years or the 10 years or the 7 years with the interest rate of the non-compete and the things we talked about. Or if the buyer thinks that that appraisal is too high, the buyer pays for their own appraisal. So now you have two. If the two appraisals are within 20% of each other, you take the mean, and that becomes the value. If the two appraisals are more than 20% apart, in other words, if each appraiser is doing, as the vernacular says, a member of the American Institute of Appraisers, which also means a member made as instructed appraisal, then you have a third appraisal performed. The third appraiser is picked by the two appraisers. If the two appraisers cannot agree on a third appraiser, which is sometimes a way to manipulate the system, then if they cannot agree within 10 days, then the dean of the Weatherhead School of Management or Baltimore College Business School or Kent State, whatever is the appropriate independent third party, picks the third appraiser. And then as part of your planning process, you make a determination as to whether or not the third appraisal should be averaged with the one it's closest to, or whether or not the third appraisal in fact becomes the value. I think that's the most effective system for arriving at a value in a closely held enterprise, and in fact usually avoids the manipulation of the system. Stipulation you can use under Section 2703. You can use a stipulation if in fact you are not related parties. If you are related parties, for example, fathers, sons, brothers, etc., the Internal Revenue Service says there's a family relationship, the natural objects of your bounty, therefore you're not really selling at arm's length value. But if you are not family, you can probably use a stipulation. The only thing I would caution you with the stipulation is that if you have not stipulated the value for 24 months and then a triggered event takes place, for example, someone's death, someone's permanent disability, departure, or discord, then default to the appraisal mechanism, because the stipulated value may become stale, and that's not fair and probably will lead to litigation because somebody feels they're on the wrong end of that. I'm on slide 9. If there's any questions, again, please feel free to go ahead and put something into the chat box so we can address it at this time. One of the things I use for family business enterprises is described in slide 9 and again in slide 10. Because one of the things I have found in family enterprises is that the stumbling block is the parents, the senior generation, having to pick which one of their children should be the viable successors and how the thing will be planned. And also what happens is when the senior generation sits down with their financial planner, their CPA, and their attorney, they put together this entire plan. They then present it to the kids and says, this is how it's going to be done. The kids don't take ownership of it. They bristle at it, and we've got a problem. So the thing that I like to use is what I call bottom-up planning, which is described in slide 10. That's where we involve the successors in the planning process. We look at them and say, how are we going to make you be involved in this process? How are you going to determine the key issues among yourselves that you often disagree on? And what can you live with? We get involved. We act as a facilitator. It can be done by other people that the members of the family trust. And usually should be done by an outside third party as opposed to the senior generation trying to facilitate these discussions among their children. My experience is that the children haven't told their parents things for years, and now to think that they're going to come and be open and honest about their feelings and the whole program is unrealistic. I did a merger of 4 companies about 10 years ago, and one of the companies, which was in fact a 5th company, but one of the most successful ones, when I interviewed the son, who was the heir apparent, who was going to be involved in the merger, he said, I hate this business. I've always hated this business. I wish my dad would just sell out. I don't want to do this. I've never wanted to do this, but it was always assumed that I would have to do it. So in fact, once we found that out, we told Dad. Dad was glad to know that. And instead of merging with the other 4 organizations, we sold out to the other 4 organizations, and everyone was much happier with the result. By going then to the successors themselves, we try to put together an agreement among the successors as to what responsibilities they will have within the organization. I'm on slide 11. How they will compensate each other. For example, will it be equal? Will, in fact, one person's salary be X and the other person's salary be 80% of X, so that if the president, in fact, raises his own salary, then he raises his brother or sister's salary by a commensurate amount? Will they receive a bonus? Will the bonus be two-pronged? A performance bonus, which is based on some performance which is hopefully measurable, and then perhaps a second portion of the bonus, which may be larger or smaller, depending on what fits the situation, that is tied to their actual ownership, the fact that they are a member of the family and they have ownership. Authority is critical in putting together a succession plan. Who is going to have authority to dismiss or fire the bookkeeper's been there for 30 years that dad or mom hired and they love, who's completely incompetent? Who's going to be able to make those decisions? Vince Granito, yes, you can certainly get a copy of the slides. There's no problem there whatsoever. Resolution. In other words, what is going to be the resolution of dispute among the members of the organization? How will they resolve what may be a business killer decision, whether or not we're going to expand the business, make an acquisition, one wants to, one does not want to? How do we resolve those issues? Sometimes we use a facilitator, sometimes we use a special director who only votes when there is a deadlock. And you want that special director to be someone with facilitation skills so you can try to reach a consensus. Because if there's a vote all the time and somebody is outvoted, that means that somebody's going to try to work behind the scenes to reverse that vote the next time around. How much ownership will each party own? Each son, each daughter, each member of the family. Non-employee benefits. What will they receive? Will they be paid a dividend? Will this be an S corporation will make substantial distributions to the family members who aren't involved in the business? What is fair? How do we implement the plan? My experience is that if, in fact, we get all of those things agreed to or reasonably agreed to among the successors take ownership of the process, and now the parents only have to endorse, accept their plan. And in fact, it's a much easier transition. Plus, more importantly, it is a very good exercise to find out whether these successors, who are going to be responsible for the strategic, successful operations of the business, which will allow the senior generation to receive their remuneration from the enterprise. Remember the 3 whats? What does the senior generation require? What can the business afford? And what's it worth? If, in fact, the parents find out and the advisors find out in doing this analysis and this process that effectively this next generation cannot work together, then steps can be taken to implement a more viable strategy, or perhaps even, which might be the only thing that will work, a sale of the enterprise, because, in fact, their ability to function is not going to be realistic. Now let's talk about the strategic plan and the exit plan. Because I remember we discussed at the beginning of our discussion that succession planning involves both ownership as well as management. Closely held enterprises don't run themselves. Even my clients who are successful business people and spend their winters in Naples, they still run their business, although perhaps remotely, but they stay on top of things. They stay on top of key elements of the business, key numbers that they monitor that tells them what is going on. And they can do that because they understand their enterprise. They have delegated appropriately down to qualified people, but they still maintain key strategic decision-making authority. And the way I test this then with the senior generation, whether it be a family enterprise or not, is what are the 3 key functions you perform? And if, in fact, you come up with more than 3 key functions, you probably have too many. You are not properly pushing things down to the appropriate level, because there are certain things that you probably can do better than other members of your organization, but because you're spending time on doing those things, you are not getting to the things that only you, as the most senior and most experienced member of the organization, can address, or the most strategic-minded person in the organization can address, because you're still tied up with doing day-to-day things. So there, once you've determined the three functions that you perform that are critical to your enterprise, what happens if you can't perform them? What would be the impact? So when you're putting together a business plan, a strategic plan, and ultimately an exit plan, whether you're going to sell the business or pass it on, there's got to be management in place to run this enterprise. And you've got to make the assessment is what would happen if, in fact, you can't do these things. And if there's no one sufficient to do these things for you, I'm on slide 14, should the business be sold? Should you tell your spouse, partners, that the business should be sold? And if it's sold, what is the realistic time frame? Do you hire an investment banker? What do you do? If it's not going to be sold, do you hire a replacement? And if you hire a replacement, is the replacement someone that you've identified on the staff that's capable of taking over, or is it more realistic to go outside? It is essential that as part of the succession plan that the management aspects be addressed. If the business is going to be sold, should your wife run it? Should your partner run it? Should your kids run it? Should your key employees run it? Who's going to run your business if you can't? That's got to be part of a succession plan. It's got to be part of an emergency management plan. Sit back and ask yourself, if you can't run the business, how vulnerable is it? Would your customers leave? Is the business tied to your personality, your contacts, your relationships, or has the business been institutionalized and your customers, your suppliers, look at your business as an entity, not you who happens to have a business? You want to, if you can, create an institutionalized enterprise that people look to as, in fact, their customer or their, in fact, supplier, not you per se. And the third key aspect is if you can't run the business and the business appears to be vulnerable, will it appear to be vulnerable to your employees and your competition? And will, in fact, your employees bolt to take care of their own interest? And, in fact, they will take care of their own interest despite the fact that you want them and have always assumed that they would take care of your family because you've always taken care of them. Unfortunately, that's not the case. They will do what is in their best interest. Hopefully it's in your best interest too, but you have to be realistic about what is going to be the situation. And if non-competes are required or incentives, perhaps that's what should be done. Now, we're not talking about just ownership. We're talking about management. So if you had to replace yourself, would that person have a financial background, a sales and marketing background, be an administrative person, be an entrepreneur, have industry experience? What would be required? And again, trying to replicate yourself is probably not the key factor. And what I tell clients is that the successors are going to do it differently. But keep in mind, different is not wrong. Different is simply perhaps better, perhaps worse, or perhaps just as effective. It's simply different. Now, I'm on slide 17. This is where lots of entrepreneurs find it very difficult when putting together an effective, strategic plan and ultimately the exit plan. Who do they give their authority to? Do they give it to an individual like they currently enjoy, or do they give it to a committee? And if they give it to a committee, who should be on the committee? How should it be constituted? Should it involve key members of the organization? Should it involve the outside accountant, the outside attorney, business friends or advisors? Should it involve family members? Who should be involved in operating a business? And realistically, can your enterprise be operated by a committee? Or does authority have to vest in someone? Perhaps a committee with an individual who has veto power? Who is going to make those decisions? That's a very difficult discussion to have with the senior owner, particularly a senior owner who probably started the business. And because they started the business, they're a very successful entrepreneur. And most successful entrepreneurs are not good at delegating and are even worse about giving away decision-making authority. But it is an essential element to making sure a succession plan is going to be implemented successfully. There are various techniques we can use in implementing a succession plan. And I want to discuss some of these to give you a flavor in terms of what you perhaps can have implemented for your clients or your own enterprise in terms of doing the three things. Creating a business plan that's going to sustain the organization. a strategic plan that's going to pass the organization on to the next generation, and ultimately then what the exit plan would be in terms of passing that succession on or in fact selling the business. Gifts are an estate planning technique which are commonly used to pass ownership from one generation to the next. We all know that you can gift up to $13,000 per year per donee, and I don't believe that's going to be adjusted this year because we have virtually no inflation, so it should remain $13,000 per donee per year as a present interest gift. And then you can make gifts up to $1 million without paying any gift tax or incurring any gift tax. Beyond that, there is going to be some potential gift tax exposure, and therefore if you're going to make a gift of a closely held enterprise, an essential element of making a gift of a closely held enterprise is having a proper valuation of the enterprise done. Because if you make a gift of a closely held enterprise, you are required on Form 709 to file substantiation of how you arrived at the value and substantiation of whatever discount you may have taken in arriving at the value for tax purposes. So having a valuation of the enterprise is almost a jumping off point to start an effective closely held succession plan that's going to involve transfers of ownership for tax purposes. An installment sale is a common technique that is used in family enterprises as well as unrelated family enterprises, unrelated buyers and sellers, because it allows the enterprise to help fund the purchase price. In this market, 2009 and so far in 2010 in my discussions with private equity groups and banks, the banks are still not loaning money for the kinds of transactions we were doing in 2007 and 2008. So if you want to sell your enterprise and somebody wants to buy an enterprise, an awful lot of the financing, if not all of the financing, is going to be done internally without bank financing. The banks will put up lending and funds to operate a business, such as operating lines of credit, perhaps capital for the acquisition of new equipment, the acquisition of new real estate, or the expansion of real estate, because that's creating new assets, which are new collateral. They are reluctant, or have been reluctant for the last, let's say, 14 months, to put up funds for acquisition of ownership without creating new collateral. In any form of succession plan and exit strategy, we use a form of buy-sell agreement. A buy-sell agreement can be in a lot of different varieties. It can be a close corporation agreement that includes not only buy-sell provisions but also operational decisions. It includes things such as how many directors will be involved in making decisions. It involves things like if there is a deadlock on the board of directors, how that deadlock will be resolved. It may, in fact, include such things as compensation, how bonuses are determined, etc. A close corporation agreement, it can be an all-encompassing agreement, all aspects of the ownership of the closely held private enterprise. An operating agreement is basically a close corporation agreement, but it is for a limited liability company. It is simply another name. It's like a partnership agreement in the sense that it lays out all the relations between the members of the LLC. An LLC is by far the most commonly used and I think the most useful form of enterprise today, because it doesn't have the restrictions that S corporations have in terms of ownership and the number of members who can own an interest, and more importantly perhaps, the requirement in an S corporation that you must make proportionate distributions whether or not that person is active in the business or not. A limited liability company gives you tremendous flexibility. And obviously this allows you to be taxed as a C corporation if you choose to, although that's very infrequently done. And a LLC is generally taxed as a partnership if there's more than one member, and could in fact elect to be taxed as an S corporation if it chooses to. So it is by far the most flexible. A partnership agreement could be done if you're going to use a limited partnership. I would not recommend that you use a general partnership, because a general partnership by definition means that there is personal liability of the partners. That's why partnerships and limited partnerships have fallen out of favor, because a limited partnership by definition means that there must be a general partner who has personal liability, whereas a limited liability company gives you all of the tax benefits of a partnership without any form of personal liability of any member at any level, even the managers who make the decisions. I will remind you, because we're getting close to the end here, if you have questions, feel free, please, to jump in And I'm going to go on to keep addressing some of these techniques without getting too involved in them. So another technique, installment sale to an intentionally income defective trust. I like this this particular technique. And this particular technique, for all intents and purposes, has been around long enough. And there's a 2004 revenue ruling that deals with some of the income tax aspects of this technique, which effectively means the IRS accepts it. They don't necessarily like it because it's so effective, but in fact, they recognize that it's a legitimate transfer mechanism. Self-canceling installment note. That's what SKIN means, or skin. And a self-canceling installment note basically means that if you sell the enterprise to an individual, that individual then is going to keep on paying until you die. When you die, then the note is canceled. Obviously, if you die prematurely, that person has paid very little for that business, perhaps substantially less than its fair market value. Because you could potentially pay substantially less than its fair market value, then a self-canceled installment note must have one of two aspects. It must have an interest rate which is above the normal fair market interest rate at the present time, because there is obviously an economic benefit to the buyer. They have to pay for that economic benefit of the fact that the seller may die. Or the purchase price tied to the fair market value of the business must have a premium associated with it for the same reason, because there is a potential tax bonanza or economic bonanza, that may be flowing to the buyer, because the note itself may be canceled because the seller will in fact die prematurely. Short-term grantor annuity trusts, so-called zeroed-out grats. They're very popular short-term grats, whereby you transfer an interest in a closely held enterprise. The grat is only for 2 years, and you hope and pray, and the scheme is that this closely held enterprise is going to appreciate over the next 2 years, and the appreciation will all flow to the next generation without any gift tax or income tax consequences whatsoever. So it begs the question, if the asset is not going to appreciate value, a grat is useless, and in fact, the reason to use a short-term grat is because the grantor must outlive the term of the grat for it to be effective at all. The Obama administration does not like short-term grats and has suggested in their most recent green paper, which is basically the administration's analysis of the tax code done on an annual basis, and what they'd like to see changed is they'd like to see the grantor annuity trust changed to a minimum of a 10-year grat. In other words, the grantor must live 10 years for the grat to be effective. For those of you who are not familiar with it, a grat is simply a trust that says that the grantor is going to retain an interest in the trust for a fixed number of years and a fixed percentage. And that fixed percentage is calculated by the number of years that they will retain an interest and what that percentage is. And that retention is subtracted from the fair market value of the property that's transferred. And the short-term grat means that the grantor has retained, because they retained 51% the first year and 49% the second year, for example, of the value of the enterprise, that they have retained all of it, so there is no transfer. In other words, there's no gift. That's why it's called a zeroed-out grat. Now, if in fact the property appreciates over that 2-year period, and the most common technique is where a closely held enterprise anticipates, without being already legally bound, anticipates that it might sell the business in the next 12 to 18 months, and they have a valuation that says the business is worth $5 million, but they think in their heart of hearts it might be to sell for $8 million. And obviously what they've done is they've transferred that $3 million of purchase proceeds 100% tax-free and gift tax-free by engaging in a grat transaction. Obviously it can be done with real estate. It can also be done with marketable securities, etc. The key component is the asset must appreciate in value. Other techniques, I'm on slide 20, deal with a long-term grat, which is just as what I described the Obama administration would like to see. The technique is the same, except the period of time is 10 years. Certainly over a 10-year period, you can substantially reduce the value that is being transferred. But for the technique to work, the grantor must in fact exceed the retained period, the 10-year period. One of the ways to take care of that contingency, the contingency being that they don't live the full 10 years, is to insure their life to pay the estate taxes out of an irrevocable life insurance trust if in fact they don't live the full 10-year period. Family limited partnerships and limited liability companies continue to be very viable alternatives to reduce estate taxes and to engage in succession planning. The concept is that once the asset is transferred to this vehicle, its value is reduced for transfer tax purposes, transfer tax being gift taxes and estate taxes. A limited liability company is becoming the more popular technique because of the things I had previously discussed. And the family limited partnership continues to be a focus of the Internal Revenue Service, and transfer techniques involving flips, as they're called, that involve last-minute transfers to the flip, let's say as little as 2 days, as little as 30 days prior to the grantor's death, using a power of attorney where the grantor is no longer competent to make the transfers themselves, where they transfer all of the grantor's assets, their marketable securities, their life insurance, their closely held business, their rental property, etc., so that they virtually have no assets to maintain their lifestyle outside of the partnership, don't stand muster. The IRS will blow those up. So family limited partnerships and limited liability companies done correctly, done where there's plenty of time to implement them, done where only a significant portion of the personal assets to maintain the lifestyle are retained outside of the flip, work. It's the same old story where people try to get a little too greedy and too aggressive. They usually get shot in the foot, and that's common. A private annuity is just that. It is a pledge by the buyer to buy the enterprise or the real estate from the seller transferor. For a private annuity to work, again, you must have a credible valuation of the underlying asset that is being sold pursuant to the private annuity. The reason a private annuity is a popular succession planning technique, particularly in families, is the buyer pays the seller for the rest of the seller's life. If, in fact, the seller dies prematurely, the buyer gets a bonanza and there's no tax consequences. If, in fact, the seller lives beyond their life expectancy, the buyer has to keep paying. So in a private annuity standpoint, a theoretical buyer could pay more for the business than it's really worth for tax purposes because the seller outlived their life expectancy. And the key thing about a private annuity is it cannot be collateralized. It has to be a simple promise to pay by the buyer to the seller. And obviously, therefore, if the buyer gets in trouble and fails, the seller will, in fact, not realize their benefits. Now, we have 4 minutes to go. I really don't want to get into the details of a sale to a defective trust, but I'm going to show you one thing, and that is simply how the trust works. I'm in slide 24, the last slide. Tim Sisler is asking what are the advantages and disadvantages relative to succession planning in operating real estate in separate entities like a flip or an LLCs. Well, my reaction is the reason that business real estate developers operate in separate entities is to go ahead and separate their exposure in the development process from their own personal assets. For example, if you're a West Side developer and you're doing a project in Avon and you thought you were going to have some big box tenants that were going to come into your project, and in fact they have not, pardon me, and now you owe the bank a great deal of money and you can't convert that project into cash flow, perhaps that project will fail, and perhaps the bank will take back the real estate. But if you've done it on a non-recourse lending basis, the exposure of your other assets, which are held outside of the LLC or the flip, will not be considered as part of the collateral which the bank has access to. So it can be a significant benefit. Plus, succession planning in real estate and separate entities, you might be able to pass certain valuation discounts in certain enterprises in one entity versus another entity. For example, you may have real estate in one project that has issues associated with it. And right now what we have is clients with tenants who are canceling and leaving the organization. And those particular values may be lower than a good, solid residential development, which in fact has all the houses sold or under contract or significant. So if you separate them, you're going to obtain your valuation discounts more readily. Pat, you can get a copy of the slides, of course. If everyone will just send me their email address or make arrangements, we'll send you a copy of the slides, or the center can do that as well. Mike, I think the Obama administration will probably not tackle monumental estate tax reform in 2010. I think in 2010 we'll be doing well with everything that's going on with health care, et cetera, if we get an estate tax bill that freezes the exemption equivalent of $3.5 million, allows the merited deduction to remain intact. There are proposals to do what I suggested, and that is that the GRAT would be a 10-year GRAT minimum. There are proposals that would eliminate the need for AB trust planning. What I mean is this, that if one spouse dies without using their full $3.5 million exemption equivalent, then their surviving spouse, assuming they don't remarry, for example, could use the unused portion of their exemption equivalent. So we can clearly tell clients you can die with $7 million, and if your spouse dies first and only uses $1 million of their exemption equivalent, you get $2.5 million of their unused exemption, so your exemption becomes $6 million at the time of your death, not $3.5. That's a proposal. And there are also proposals to lower the tax to 30% as opposed to 45% at the present time. My sense is that we're going to get simply a bill that will freeze the estate tax at its current level. Everyone is familiar with that level, $3.5 million, a 45% flat tax, an unlimited merited deduction, and perhaps more importantly, a full step up in basis and assets that are in someone's taxable estate at the time of their death. A financial planner called me yesterday. He had a client pass away this week, and they have a significant holding in a marketable security with an extremely low basis, and he was beside himself because he realized that there is no step up in basis under the 2010 law. Well, I reminded him, however, there is a step up in basis of $3 million if the asset passes to the surviving spouse, and a step up in basis of $1.3 million to all other transferees. So in this particular case, they had an $800,000 marketable security with a basis of about $115,000, but because it's under the $1.3 million, they are in fact going to get a step up in basis, so they can diversify that portfolio. And again, the current thinking is we'll have $3.5 million, a step up in basis, unlimited merited deduction. All of those things will remain in place, and they probably will not implement the GRAT reform that they're talking about. Pat asked, if you received your stock as a gift when the stock is sold, do we have to pay tax on the difference between zero and what it is sold for? Well, your gift is not a zero basis. What the gift basis is the basis of the grantor. So if the person making the gift had a $10 basis in the stock and the stock has a $20 value, your basis is 10. It is not zero. You get a carryover of their basis. So we always tell clients who are considering making gifts, you can't look at just the fair market value of the asset that you're gifting. You want to take a look at the basis of the asset that you are gifting. A common mistake that is often made, and I call it the Aunt Tilly syndrome. And the example I give is Aunt Tilly, who bought her house in Parma, Ohio in the 1950s and paid $15,000 for it. That house is now worth $250,000, and Aunt Tilly wants to leave it to all of her nieces and nephews. Well, Aunt Tilly gets sick, and 2 days before she dies, someone under a power of attorney transfers Aunt Tilly's house to all the nieces and nephews to avoid probate. Well, that transfer to avoid probate is also a gift. And even though there's no gift tax paid on that, there is a locking in of the carryover of basis. So Aunt Tilly's basis of $15,000 is carried over to the nieces and nephews who inherit it, and then they turn around and sell it for $250,000. They have to pay capital gains on $235,000. If they had waited till Aunt Tilly died, or to put it into a trust so to avoid probate, or do it as a transfer on death deed, there are lots of ways to avoid probate without making a gift. They would have received a step up in basis, and then when they sold Aunt Tilly's house for $250,000, they would pay no capital gains tax whatsoever. So paying attention to basis when making transfers of taxable assets, including wholesale business interests, is essential to good planning. Other questions? I like the questions. Can we get any more questions?
Jim, did you address Bill's question on estate tax reform?
Do you see the tendency to wait on estate tax reform being more or less prominent right now? Yes, Bill, I do. I think I've even heard things that the Democrats are trying to punish the Republicans for having passed this tax. There is some thought that the Democrats will simply let the entire tax be implemented so that in 2011 we actually go back to $1 million. and a tax rate of 50%, et cetera, which I think would be disastrous. So yeah, there seems to be no great hue and cry to make estate tax reform this year, which is why I think the only legislation we'll get of any consequence will probably be a freeze. It seems to me we'll get a freeze, but it also seems to me, although there is case law at the Supreme Court level that says Congress can in fact make tax changes retroactive to the first of the year, those tax changes have been income tax changes where there's some planning involved. It seems to me that if an individual dies in 2010 before they enact new legislation, that person should be subject to the zero estate tax regimen, and that if they do pass estate tax reform, it has to be prospective legislation. In other words, it'll be applicable from the effective date of legislation forward, not retroactively. But there are other people that say they think that literally they can pass legislation in May that will be effective to January 1st, and anybody who died between January 1st and May will still be subject to perhaps the new estate tax regimen. I think once they get past 9 months, in other words, if somebody dies and then more than 9 months has passed where they were required to file their federal state tax return, I think it's going to be very, very difficult to make it retroactive. And you can even say that if somebody has died in January, one of the things they should probably do is file their state tax return as quickly as possible to try to start statute of limitations running so they can try to take the position that they are, in fact, under a no-tax regimen. Did I miss any other questions?
Interesting situation. Thank you, Jim. You've covered an awful lot of material in a short period of time. What I'm going to do is open up the lines here in just a minute for some general questions, a little Q&A session. I have a question, but first, let me post on the screen your contact information for those of you that would like to get
yeah, it's a PowerPoint presentation. I'll be happy to email it to you.
Yes. I'm waiting for it to come up.
Okay. I can give it to everyone. It's J. Awesome.
Yeah,
there it is.
There it is, right there. It's right in front of them.
Yeah, in red there.
Good. So you can, if you would like copies of the presentation, or if you'd like to get in touch with Jim, you have that contact information in front of you. I have a quick question, Jim, as we wrap up here. The title of our session today is Where the Business Plan, Strategic Plan, and Succession Plan Meet. In your experience, if an owner of a closely held small business comes to you with a desire to begin an exit plan, looking at retirement, what's the likelihood, Jim, that there will be a strategic plan? Or if there is one, it will be documented? Because in my experience, a typical entrepreneur doesn't do a strategic plan.
In the context of what I'm talking about today, I look at a strategic plan in the form of a succession plan. In other words, what is going to happen to the ownership as well as management of this business? The business plan, in my context, is that second W, or the second what. What can the business afford? You've got to have a reasonable business plan because there's going to be a time frame over which this strategic succession and management plan is going to be implemented. I agree with you that formal strategic plans, even when done, are often just put on the shelf. They come up with the mission statement and a couple other things, and they come up with the so-called SWOT analysis: strengths, weaknesses, opportunities, and threats.
Right. And
they go through this whole analysis of what can be done. But I'm not talking about that kind of strategic plan. I'm talking about a strategic plan that deals with who's going to own this business upon your death, your disability, your departure, or discord, and who's going to run this business if you can't. That's what I look at as the business plan and strategic plan. And then ultimately the exit plan is, what is the ultimate transfer going to be? Are we going to transfer it by using a gift, by using an installment sale, by using an intentionally defective trust, a private annuity, or some combination of all of the above? In family enterprises, we often use combinations. What is going to be the exit plan where the senior generation no longer is the owner of the enterprise? Or if you're not in a family enterprise, what is your exit plan? How are you going to be compensated? How are you going to receive the value from your enterprise? How are you going to sell it, so to speak? Right.
So a small business owner would be very prudent to do some of that thinking up front as they move into the exit planning stage.
It's essential.
Right.
Who's going to own it and who's going to run it? And then probably one of the jumping off standpoints is, what's it worth? What's it worth for tax purposes? And once you get that valuation, you can have it updated every couple of years for a fraction of what it costs to do the first one. But it's an essential element of doing proper planning.
Great. Thank you. I'm going to unmute everyone right now.
The conference has been unmuted.
So at this time, if anyone would like to jump in with a question before Jim signs off, feel free to do so.
Yeah, I have a question. We're a small architectural firm, and how does an ESOP play into selling the business or continuing the business?
ESOP is an employee stock ownership plan, and I did one of those 2 years ago for an architectural firm here in town, and you can use it. It's a quick back-of-the-napkin kind of analysis to see if it's workable for you. There are two critical aspects to an employee stock ownership plan. An employee stock ownership plan is a qualified plan, so it's basically a pension plan. And the contributions to it are tax deductible, which is why it's so attractive as a succession planning mechanism, because it's the only way to really buy a business with 100% tax deductible dollars. So the first thing you have to look at is how much payroll do you have? If you've got a lot of employees and a lot of payroll, then you have perhaps sufficient payroll to make annual contributions that will pay for the business. If you've got a very small firm where you've got 3 sellers and you only have 3 other employees, an ESOP is probably not doable. If you have a fair number of employees with a significant payroll beyond the owner's payroll, it may be doable, and you look at perhaps a percentage of the payroll anywhere from 8% to 12%. Technically, you can contribute up to 25% of qualified payroll to an ESOP on an annual basis, but that may not be a realistic funding number. The second aspect of seeing whether or not an employee stock ownership plan might work for a closely held enterprise is having an evaluation done. We often engage the evaluation expert ourselves so that if the evaluation doesn't come in at a number that is favorable, it's been given to me as the attorney and as attorney-client privilege, and we don't have to use that valuation. But you have to first find out what the independent appraiser says the business is worth, because an employee stock ownership plan, as one of its requirements to have the tax benefits it enjoys, it must have an independent appraisal done on an annual basis. And if that appraisal says the business is worth $3 million, but you're only willing to sell it for $5 million, then an ESOP is probably not realistic. If in fact you want to sell for $3 million and the evaluation expert says it's worth $3 million, then you've got a viable jumping off point then to take a look at, all right, how much payroll do we have? Can we fund a buyout over time by making payroll contributions on a tax-deductible basis to the ESOP? Because an ESOP can be used as a mechanism to make installment payments from the ESOP to the seller, or the ESOP could actually go to a bank, borrow the entire amount of proceeds, pay the sellers off in cash, and then the ESOP has annual obligations to the bank. It's called a leverage ESOP. And those tax-deductible contributions that the business makes to the ESOP annually are then made to the bank to pay off the bank debt. So the two factors to see whether an ESOP might work for your architectural firm would be how much payroll do you have outside of the owner's payroll? You can't count your own payroll as part of that valuation, that analysis. And then what do you think your business is worth? And to have it really done correctly, you've got to have an independent appraisal done.
Big step, yes. Good answer, Jim. And obviously, Jim and or the OEOC can help you through that process in evaluating whether or not an ESOP is a viable option for your company. We have been seeing more install an ESOP.
Yeah, yeah.
So architectural firms included. So there's some precedent, and there's a model that has worked for other companies in your same situation. So don't hesitate to contact Jim or the OEOC for more information.
Sure.
Any other questions? Well, thank you, Jim. We've gone a little bit over, but I think it was well worthwhile. Just a reminder.
I hope you enjoyed it all.
Yep. Thanks, Jim.
Yeah, thanks, Jim. Good presentation.
Thank you.
Yes, thank you.
We will archive this session for future viewing. Please see our website for access to this and other webinars and podcasts. Just a note, over the next month or so, we will be presenting additional webinars on the 19th of January, Employee Ownership Sustainability, Will Your ESOP Last Forever, with Jim Steiker of SES Advisors. On the 21st, Selling to Managers Persons with Dave Gustafson at Apple Growth Partners. And on February 9th, Small Business Planning for Multiple Shareholders with Tom Gilbride. And then on the 11th, I will talk about the ESOP, maximizing the ESOP benefit by creating an employee ownership culture, which could be a real advantage in moving to the ESOP. So look at the website, and we encourage you to attend future webinars. And thank you very much.
Thank you.
Thank you. Bye-bye.
Jim, are you still there?
Thank you. Please